Morning everyone, welcome to Ainsley News. It's Wednesday, the 16th of February. Volatility and gold in 2022. Gold and silver took a bit of a hit last night on news that Putin had withdrawn his troops and the inference that the invasion is no longer on. Despite Biden reassuring everyone that the reports were not verified and that an attack is still very much a possibility, the market elected to go with everything is awesome once again. Indeed, despite shares momentarily dumping, it even went on to look past the bigger than expected and record high PPI print out of the US. If you can recall from earlier this week, the gap now between CPI and PPI is screaming more trouble ahead, and it got worse last night. The latter is important because the bond market is now firmly pricing in an aggressive rate hike, but the share market is arguably not pricing in the full implications of it. We have shared a number of different analysts' warning of the volatility ahead in 2022 markets, and that assumptions that gold does not do well in tightening conditions are objectively false. Goldman Sachs again this week gave the following insights. A common concern for gold in 2022 is looming Fed hikes and the potential for longer or higher long-term interest real rates. However, we find that historically gold tends to increase during rate hike periods when gold's negative correlation with long-term real rates also tends to break down. This is already happening, with gold displaying resilience to the most recent increase in US 10-year real rates. In our previous research, we argued that this has to do with the fact that the rate hikes themselves can lead to fears of a growth slowdown and recession, and therefore boost demand for safe haven assets such as gold. This means if inflation fails to slow down the second half of 2022, and the Fed is forced to hike those rates more than currently expected, gold should be resilient, as this would increase fears of a potential recession. Gold is beginning to disconnect from real rates. 2022 looks to be closer to the 2004 to 2006 hiking cycle versus the 2017 to 18, as our economists expect a material slowdown in US growth and our EM dollar GDP growth forecast. While not as strong as in 2004 to 06, it's still positive, unlike in 2018. The negative correlation between gold and real rates breaks during every hiking cycle. While we often talk to the similarities between gold and Bitcoin in terms of a monetary asset, the two have performed very differently over the last couple of years. Bitcoin, whilst it's established its fair value and market cap, is a 13-year-old asset early in this journey. Whilst the prospects ahead are indeed heady, it comes with much volatility. Gold, while most boring, has reached maturity and a level of market trust born of a 5,000-year-old history. Goldman talked to this as well. Today, the global growth inflation mix is markedly different. While there is not yet talk of recession, our economists forecast a material deceleration in US growth, while the imminent prospect of a new hiking cycle is leading to a risk-off environment across long-duration asset classes. Indeed, risk sentiment has begun to deteriorate. While our portfolio strategists see a continuing growth inflation mix, keeping volatility elevated near term, it's important to remember that risk aversion is a major driver of investment interest in gold versus assets such as equities and, to an even larger extent, versus Bitcoin. In our view, gold is a risk-off inflation hedge, while Bitcoin is a risk-on inflation hedge. For investors looking for a way to hedge their portfolios from risk of a growth slowdown and falling valuations, we believe a long gold position would be more effective in the current macro environment. As we've often said, we believe this is driven by crypto's lack of use beyond a digital store of value, indicating to us that it's still too early for crypto to compete with gold or the dollar for defensive asset investment flows. That's from Goldman. Goldman conclude and forecast as follows. In our framework, two of the most important drivers of gold are fear and wealth. While US real rates are often a good barometer of fear, during periods of monetary stimulus, their signaling power breaks in a late cycle environment. Instead, we find that in an environment, the market's assessment of recession risk becomes a better barometer of fear. Based on the expected slowdown in the US economy and the increase in recession concerns, the build in gold ETFs should increase to an annual pace of 300 tonnes by the end of 2022. This, combined with a 10% forecasted increase in EM dollar nominal GDP, points to a gold price of $2,150 per tonne or per ounces. That's in US dollars in 12 months' time, which is now our new target. We lower our 3-month forecast to $1,950 or $1,950 US dollars from $2,000 an ounce, and raise our 6-month forecast to $2,050 an ounce. Earlier this month, we shared macro insiders Julian Brigden's great insights into the economic setup for 2022. In his latest piece, he's now recommending buying precious metals. This from him. The reasons to be short gold have caught traders' attention. Rising nominal yields, rising real yields down the track, the relative strength of the US dollar and etc., etc. And yet gold has not gone down. Speculative net long interest in the CFTC commitment of traders statistics on futures trading has dropped this year and is now near the bottom half of an historically unchallenging range. The gold chart tells you it could either go whichever way, but it isn't staying here. Both the bull and the bear case have been frustrated so far. We've tried this before with tight stops. I potentially want to try this again. Targets are big. Wave parity suggests 2,600 by this time next year if we get liftoff. Nice insight there. Readers will recall, and listeners, our presentation bigger picture of the cup and handle formation that we've previously shown. You will struggle to find any analyst not predicting a turbulent time ahead in financial markets for 2022. As Lance Roberts said in one of our recent articles, there's been absolutely 0 times in history the Fed Reserve began an interest rate hiking campaign that did not eventually lead to a negative outcome. Volatility has its own index, the VIX. Go and check it out if you find some time. As the market ear noted this morning, remember the old school fear hedge substitute? It just sits there, and it's been sitting there a long time. But the safe haven feature of gold has made a strong comeback in 2022. VIX versus gold year to date. Check out some charts online through our website. And gold can actually trend, which VIX can't. Yep, we've got some VIX charts there for you to check out. So whilst gold and silver got even more affordable last on easing Ukraine fears, saber rattling is not the big theme for metals this year. The bigger battle is within the US Fed. Tighten and crash the easy money addicted market and its financialized economy. Don't tighten and inflation rips. Consumers stop spending, earnings are squeezed, and recessions ensue. It's rare one asset can profit off either scenario, but that's the prospect before gold and silver right now. Great stuff. Jump over to anzbullion.com.au if you're looking to purchase gold, silver, or platinum today. You can also check out any of the charts we've shown in today's news as well. ainsleywealth.com.au for all things cryptocurrency. You can buy any of our large cap crypto and click on the dashboard. You'll be able to see some great further insight against each token where we offer it. And goldsilverstandard.com. That's our own crypto, built and backed by gold and silver. Enjoy your Wednesday, everyone. We'll catch you tomorrow for more news.